In 2017, India witnessed a seismic shift in its tax landscape. The Goods and Services Tax, or GST, rolled out with much fanfare. It promised to unify the nation under a single tax regime. Gone were the days of multiple taxes at different levels. GST aimed to simplify the complex web of indirect taxes. It sought to create a common market across India. The idea was simple: one nation, one tax. But the implementation? Not so much. GST replaced a host of taxes. These included VAT, service tax, and excise duty. It aimed to remove the cascading effect of taxes. This meant no more tax on tax. The government promised it would boost economic growth. They said it would increase tax compliance. For businesses, GST meant a new way of operating. They had to adapt to digital tax filing. Love it or hate it, GST had arrived. India's GST system is unique. It's not a one-size-fits-all approach. Instead, it has multiple tax slabs. This multi-rate structure aims to cater to India's diverse economy. It considers the impact on different income groups. The system has 5 main rate slabs: 0%, 5%, 12%, 18%, and 28%. Let's break it down. The 0% slab covers essential items. These include basic food grains and milk. It ensures that the poor aren't burdened. The 5% slab includes items like packaged food and textiles. These are daily use items for most households. The 12% and 18% slabs cover a wide range of goods and services. The highest slab of 28% is reserved for luxury items. There's also a special category for sin goods like tobacco. Critics argue that this multi-rate system is too complex. In India's GST system, not everyone needs to register. There's a threshold. It determines who must enter the GST net. For most businesses dealing in goods, the threshold is 40 lakhs. This means if your annual turnover is below this, you don't need to register. For service providers, the threshold is lower. It stands at 20 lakhs. But there's a catch. These thresholds aren't uniform across India. Some states have opted for a lower threshold of 20 lakhs for goods. These are typically smaller, economically weaker states. They fear losing revenue with a higher threshold. The lower threshold helps them maintain their tax base. There are exceptions to these rules. Some businesses must register regardless of turnover. The registration process itself is online. Businesses get a unique GST identification number, or GSTIN. Section 4. Small Business Relief, the Composition Scheme. India's GST system recognizes the challenges faced by small businesses. To ease their burden, it offers the Composition Scheme. This scheme is designed for businesses with annual turnover up to 1.5 crore rupees. It's a simplified tax structure. It aims to reduce compliance costs for small players. Under this scheme, businesses pay a fixed percentage of their turnover as tax. For manufacturers and traders, it's 1% of turnover. For restaurants, it's 5%. Service providers pay 6%. This is much simpler than the regular GST system. There's no need to maintain detailed records of each transaction. Businesses file returns quarterly instead of monthly. Despite limitations, many small businesses find it beneficial. Section 5. Global GST Showdown: India versus the world. India's GST system is often compared to those of other countries. Let's start with Singapore. Singapore has a single GST rate of 7%. It's simple and straightforward. The registration threshold is high at 1 million Singapore dollars. This keeps small businesses out of the tax net. In contrast, India's multi-rate system seems complex. The UK offers an interesting comparison. It has multiple VAT rates: 0%, 5%, and 20%. This is similar to India's approach, but the UK system has clearer guidelines. Australia's system is praised for its simplicity. Canada's system is perhaps closest to India's in complexity. Some provinces have harmonized their taxes with the federal GST. Is India's GST too complex? India's GST system has faced its share of criticisms. The most common complaint? It's too complex. The multiple rate slabs create confusion. Businesses struggle to classify their products correctly. This leads to disputes and litigation. It also increases compliance costs. Small businesses find it particularly challenging.